Gita Gopinath is IMF chief economist. Good to have you with us. Why the cut when the phase one deal has been signed and perhaps manufacturing has bottomed?
So the biggest explanation for the fairly small cut that we have, which is about 0.1% for 2019 and 2020, comes from India. We had significant revisions to growth in India, both for 2019 and 2020, and that explains the vast majority of the downward slight reduction.
How did you factor in the phase one deal? How much did that factor into your calculations?
That had an impact, for instance, on our numbers for China. We upgraded China by 0.2% for 2020 relative to October, and most of that came from the US-China phase one deal.
There seems to be a lot of optimism about this phase one deal, but having said that, the US maintains its tariffs till perhaps at least November. I mean, that's not good news.
We welcome this news, but we also press for more on this front. I mean, there has to be a more comprehensive deal. It has to be durable and long-lasting. You know, if these tensions return, that again will then undo all of the improvement in policy uncertainty that we've seen recently. So it's a bit of a wait and watch at this point.
So having said that, what are the downside risks to your projection, and how likely are we to see that?
So, I mean, the trade issue still remains an important one. We've had some positive news, but trade could spread to other areas. You know, you could have more tensions between the United States and the European Union. The US-China trade tensions could return. There are other countries using tariffs too. In addition to those, geopolitical risks are an important factor, and those have been rising, and fairly widespread social unrest in many countries.
How about the US? How resilient is it? I mean, shouldn't we be talking about recession anymore?
I mean, the U.S. economy, we are projecting, will slow slightly. It was 2.3% in 2019, and it's going to be 2% in 2020. Now, these are very healthy rates of growth. They have record low unemployment rates. Consumption spending is robust. But we should expect it to slow towards its potential because, you know, fiscal stimulus that's been in the system will fade in the next year or two.
So the Fed on hold is the right move?
We believe that's appropriate at this time, given where inflation is.
How much capacity does the Fed have should the U.S. sink into a recession after the election?
Well, so the typical recession in the past has involved about 500 basis points in rate cuts. Now, of course, that kind of room doesn't exist right now. But central bankers have experimented with unconventional tools, forward guidance and quantitative easing. And the estimates suggest that those do have a fairly significant effect on the economy. So there's more space left on that front. I mean, that said, we are flagging that it's important for fiscal policy to also play an important role.
How about the other central banks? Perhaps the ones in Asia. I mean, they've tried to keep their powder dry. Are they in a good spot if a recession were to hit?
There are many emerging markets, and not specifically Asia, but there are many emerging markets that have had inflation declining over time. So they certainly have more space in terms of cutting nominal interest rates. But at the same time, one needs to be also careful about not, you know, generating financial instability risks in the system. And there are some countries need to worry about that.
Having said that, when you take a look at the markets, there seems to be some sort of euphoria. The S&P keeps testing new highs. Is there a risk that investors could be disappointed in the months ahead?
You know, the euphoria from the market comes substantially from the very low interest rate environment. I mean, to just explain about what's driving up stock prices, the very low interest rate is probably the #1 factor. Now, the one change we've seen was while, you know, about 3 months ago, it looked like earnings forecasts were more pessimistic. We're seeing a little more optimism there again on the earnings side. But again, we do flag that there are some markets that are slightly overvalued and some more substantially. And you know, if there were a reversal in easy financial conditions, those could have an impact. Right now, of course, we're seeing tentative signs of stabilization in the global economy, and we expect the low interest rate environment to stay for long.
How closely are you watching oil prices? We heard from Anne-Marie hovering at about $60 a barrel. I mean, you talked about India just now and how you're concerned about how it's progressing. It is highly reliant on oil. How does that factor into your calculations?
So, I mean, just to give you the number, in our forecast that's been used for what we've used for this current forecast, we've assumed the price of oil to be about $58 a barrel. Now, with the Middle East tensions, we expect it to go up by about maybe $3 or $4 a barrel. But as you can see, this is not a very large change, right? So the reaction in terms of market reaction, in terms of oil prices, has been relatively muted. Now, we don't know how these tensions will evolve, and if it could become far more severe, I mean, these prices could go up more substantially. And yes, countries that rely on imports like India, oil imports like India, it could affect them significantly.
At what oil price would you have to reconsider the numbers that you released today?
I don't want to give a number out there, but it's not just the price rise, but if there's a big volatile swing, you know, over $10 a barrel, plus or minus $10 a barrel, those have an effect for both exporters and for importers.
That's been a rising call for governments to perhaps tap fiscal measures to drive growth going forward. Do you see 2020 being the year where fiscal measures will be implemented by governments?
So some governments have started implementing fiscal measures, the ones that have space. Now the question is, how much should they be doing? Now, the environment is stabilizing at this point, but there are, advanced economies around the world that need to raise potential growth. And the way we look at it is that if you're able to borrow at negative interest rates and you have projects that are going to give you a positive return, this might be the time to do it from pure cost-benefit analysis, not a Keynesian argument. And so that is an argument that we still make. We also do think that it's good for countries to prepare, have projects in the pipeline. So if and when there is going to be a more severe slowdown, I mean, it's an if, I'm not saying that there will be, but if there is a more severe slowdown, that, they can hit the ground running a little more faster than it was in the past.
Gita, just one final question before we let you go. What is the worst-case scenario for the global economy?
I think what is doing a lot of support to the global economy is easy financial conditions. There are many parts of the world where debt levels are very high, but because interest rates are so low, it's not posing a problem. Now, the question is, suppose there was an escalation of geopolitical risk, suppose the trade tensions grew wider, those conditions could change. And given where we are in terms of debt levels around the world, both in the private sector and the public sector, that could be a trigger for risks, which is why we emphasize the importance of macroprudential regulation at this time.
Gita, thank you for your insights. There you have it, Gita Gopinath, IMF Chief Economist.